Today's market moves weren't just about a red day in stocks. They reflected a deeper shift in how investors are thinking about inflation, interest rates, and whether expensive growth stories can still justify their valuations. U.S. equities pulled back after recent highs. The S&P 500 fell 0.5%, while the Nasdaq dropped just over 1%, with pressure centered in technology. The Dow was nearly flat, which tells us this was not broad panic selling. It was more selective than that. Under the surface, money was moving. Treasury yields rose sharply, with the 10-year yield climbing again. Oil surged more than 3%. Credit markets softened modestly, and sectors tied to defense and stability outperformed. Energy, real estate, and consumer staples led the market, while technology and consumer discretionary lagged. That combination matters, because when yields rise and oil rises at the same time, markets begin to reassess two key assumptions. First, that inflation pressures are fading, and second, that central banks will soon have room to ease policy. Those assumptions helped support higher valuations in growth stocks. Today, they were challenged. The immediate catalyst appears to be renewed concern around Middle East supply risk, particularly around Gulf energy flows. Higher oil prices raise the possibility that inflation could stay sticky longer than investors hoped. And when inflation risk returns, long-duration assets like technology often feel it first. At the same time, there was another layer to today's move. Investors are entering a major earnings window for mega-cap technology companies. After months of strong performance, the market is becoming more demanding. It's no longer enough to promise future AI growth. Investors now want evidence of monetization, margins, and returns on heavy capital spending. That helps explain why semiconductor and AI-linked names came under pressure. The market is asking a tougher question now. Where is the payoff? Meanwhile, capital rotated into steadier areas. Consumer staples gained, real estate was firm, energy rallied strongly. That suggests institutions were not exiting markets entirely. They were repositioning toward pricing power, dependable cash flow, and inflation resilience. This is an important distinction. When markets panic, everything gets sold. When markets rotate, leadership changes. Today looked much more like rotation than panic. One interesting debate investors are having right now is whether this is simply a healthy pause after a strong rally or the beginning of a broader repricing in leadership. I'd be interested to hear how you see it. Feel free to share your view in the comments. There are also some hidden fragilities worth watching. A large share of index strength has been concentrated in a handful of AI-driven names. If confidence in that theme weakens, passive flows can reverse quickly. Credit markets also softened slightly today, not dramatically, but enough to suggest some caution beneath the surface. And the split between staples rising while discretionary stocks fell may hint that consumers are becoming more selective with spending. So what is the broader macro message? Markets may be transitioning from a liquidity-driven narrative to a fundamentals-driven one. In other words, investors are becoming less willing to pay premium multiples based on optimism alone. They want earning strength, pricing power, and resilience in a world where rates may stay higher for longer. That is a meaningful shift. Looking ahead, the next major test will come from mega-cap earnings, upcoming inflation data, and Federal Reserve communication. If earnings remain strong and guidance holds, confidence could stabilize. If margins weaken while yields stay elevated, valuation pressure may continue. What this suggests for investors is that markets are becoming more selective. Leadership may no longer be driven purely by momentum, but by durability. The broader takeaway from today's reaction is that rising yields and rising oil prices can quickly challenge stretched narratives. But markets rarely move on a single story, so I'd be interested to hear how you interpret today's signals. If you enjoy this kind of calm, analytical breakdown of global markets, consider subscribing. I publish regular briefings focused on the deeper forces shaping market behavior. Thank you for spending a few minutes here today. I appreciate you being part of the channel.